This video walks through the answer to question number 6 in the Financial Analysis Workbook. Here we model a split of cash flows among different investors in the building and see how that affects each investor's returns. The first part of the exercise is to simply fill in the cash flows that we came up with in exercise number 5. So please refer to my last video if you have questions there. Instead, I'll go straight to the cash flow splits. Real estate projects generally have multiple investors. Typically, one investor is the general partner, or GP, and other investors are limited partners, LPs. The GP manages the day-to-day activities and decisions surrounding the project. The LPs are, as the name implies, limited in their control and decision-making. Typically, LPs provide a bulk of the capital and take a passive role, expecting a financial return on their capital. The best deal structures align objectives of all partners. In most cases, the GP has an incentive to achieve higher returns, often in the form of a disproportionate share of project cash flows above a certain hurdle rate agreed upon by the two parties. In this exercise, the deal is structured as follows. The GP puts in 10% of the required equity capital and LPs put in 90%, shown up here. The GP gets 30% of all proceeds after the investment returns 8% to investors, both the GP and the LPs. This additional 20% to the GP, or 30% minus the GP's existing 10% economic interest, is referred to as the promote, or promoted interest. Let's go through how to model this. First, we have our gross cash flows line. This is gross of any partner compensation. These feed into a calculation that determines when the hurdle is met and what excess proceeds above that hurdle are generated, which is this section here. First, all we have to do is model the cash flows necessary to get to 8%. So we simply multiply our invested equity by 8% every year. As we select our invested equity, we anchor the column by pressing F4 3 times, and as we select the hurdle rate, we anchor it by pressing F4 once. When we press F4 3 times, it only anchors the column. When we press F4 once, it anchors both the column and the row. Now as we move down, the 8% will stay constant, and as we move right, the 8% will stay constant. However, as we move down, the initial equity outlay will change, depending if it's the GP or LP, but as we move right, it will remain constant. Below that, on the line titled Surplus Deficit to Required Return, we will keep track of whether or not we achieved our hurdle, and by how much. If we run a deficit in any given year, this number goes down by that deficit, and if we run a surplus, it goes up. Therefore, all we need to do is sum up the cash flows minus the required returns that we calculated above. As you can see, however, just doing this will result in a surplus in year 2, which doesn't make sense given our large deficit from year 1. So one last step we have to do is add the previous year's deficit, but only if it was a deficit. Therefore, we'll use the min function in Excel to only capture it if it was negative. In the step above, all we did is figure out what the required return would be to each investor to achieve the hurdle rate, and by how much our cash flows exceeded the cumulative requirement in every year. Next, we want to actually see what each investor gets up to that required return. First step to this is to split our cash flows 90-10 in accordance with how each investor contributed their capital. So we give 90% to the LPs and 10% to the GPs. However, as you can see, this will also distribute the cash flow surplus 90-10, which is wrong because, as I mentioned earlier, after the hurdle, we want to increase the share that the GP receives. So to fix this, we reduce the cash flows that are split 90-10 by the amount of the surplus. To do that, we can use the max function in Excel in order to reduce it only if a surplus occurs, which we calculated in the section above. Be sure to include it in parentheses because you want that to be multiplied times 90% as well. Or times 10% in the case of the GP. Lastly, in this section, all we have to do is take the surplus and split it 70-30. Again, we can use the max function. Alternatively, we can just use the total cash flow minus what has already been distributed as part of the preferred return above. So total cash flow minus what's been distributed. The formatting there was a little funky. Next, we show the cash flow to each investor simply by adding up the relevant lines. So the total cash flow to the partnership is simply the gross cash flows. The total LP share is the preferred payment plus the surplus share. And the total GP share is the GP's preferred payment plus the GP's surplus share. We then use the lines to calculate the project's return, the LP's return, and the GP's return. Again, just using the IRR formula. As you can see, the GP's return is much higher than the LP's due to that oversized share in the profit. Now that the model is built, you can manipulate this to see how the effects that different splits would have on the GP's and LP's returns. A good test to perform is to keep the split after the hurdle 90-10 and verify that the returns are to both the LP and GP are the same. In other words, change the 70-30 to 90-10. You'll see that all the IRRs are 20%. If we make it 80-20, it's a little more in favor of the GP, and 70-30, which is our base case, is even more in favor of the GP.